Good morning, everybody. We're just going to give it 30 seconds while attendees trickle in, and then we'll kick it off. All right, good morning and welcome to the March webinar. I am unmuted. I'm Justin Faraccio. I am one of the partners here at SevenBridge. I think everybody on the call knows me. It's Chuck Eberly.
Hey, good morning. Happy St. Patrick's Day.
That's right, it is St. Patrick's Day. Good. Well, we're going to go ahead and kick off. I'm going to share my screen and we'll start talking about what's going on, because there's a lot going on. So pretty packed agenda today. Just kind of a reminder, the way this is set up is, meant to be a monthly update on what we see happening in the economy, markets. We bring in guest speakers 4 or 5 times a year, but this is your time. It's kind of meant to replace us doing a monthly newsletter. We found this to be more engaging. People have enjoyed it. But as a reminder, everyone on the call is anonymous. Chuck and I can see who's on the call, but if you have questions, you can just send them to the chat. They come to me with discretion, so I see them. We'll answer as many questions as we can. If the questions are really specific to your situation or your account, we'll write them down and we'll give you a call today to discuss them in person. So we're not talking about your stuff on the webinar. And always feel free to forward this to anybody in your network that may find this informative or interesting. So kind of as always, we'll start with looking at market performance, where the markets are year to date. We'll do a geopolitical update about Iran. We'll talk about oil and market impacts. And then we're going to talk a little bit about some economic data, jobs and inflation, key takeaways, and then we'll get to questions. And we'll try to answer questions as we go too. So year-to-date performance as of this morning, the Dow is now down 2.4% in the year. The S&P 500 is down about 2% in the year. The NASDAQ, which is more technology and growth-focused companies, is down 3.7%. Russell 2000, that's more mid-cap and smaller cap companies, so smaller than the large companies that sit in the S&P 500 and NASDAQ. It's about up 1% for the year. The equal weight, which takes the S&P 500, which is weighted by market cap. So the S&P 500, is close to 8% NVIDIA, for example, because it's the largest company in the world. The equal weight takes all 502 companies and divides them and makes them equal. So it gives you kind of a more good representation of how the economy is performing overall. That's up about 1.6% in the year. And then bonds have remained flat, with, we think, potential upside here coming. Let me go back here real quick, because I do want to point out one thing, because the markets are down this year. Every account we manage at SevenBridge is a little bit different. They're all kind of built for your custom situation, your custom risk tolerance. So, but across our portfolio, our whole book, we are up 1.5 to 2% for the year. So we are outperforming, and we can talk a little bit about why that's happening. And so most of you in the call will see that your accounts are still up for the year, even with the volatility that's going on. The people that are more growth focused and risk on, may not be up as much, but just wanted to point that out real quick. So, the hot topic that everyone's talking about is the conflict with the United States and Iran. So that obviously kind of started here at the end of February. US and Israel have, striked multiple times in Iran. Iran has struck back with Israel. We're all familiar with what's going on there. The big impact now is the Strait of Hormuz is still largely shut down. There are some ships getting through, but that's impacting nearly 20% of the global oil supply. So that is a bigger deal. The shipping disruptions we just talked about, and then energy markets remain highly sensitive to the developments. And that's why you've seen volatility with oil prices specifically over the past week. And so we're kind of still anticipating the conflict comes to an end relatively soon, not as soon as any of us had hoped originally, but we're thinking we're getting closer, and that's starting to be reflected in oil prices and markets over the last couple of days. And we'll talk a little bit more about that as well. So oil prices and market ripple impacts and effects. So crude right now is, trading between 94 and 95, um, down from well over 100 last week. And so energy prices are still sharply higher year to date and month to date. And VIX volatility, so that's a measure of volatility in the market and perceived kind of risk and of what's happening out there and fear, right? So that index was all the way up to 27 last week. It's down to 22, 22 and a half as of today. And just to kind of put that in perspective, in a low fear environment, low risk environment, that measurement's usually between 16 and 17. Historically, it is close to 19. So we are a little bit higher than the historic average, but we have come down pretty strongly over the last week, which indicates to us that the market is starting to see past the conflict, past the risk associated with the conflict. We're not through it yet, but the market is starting to price it in as seeing a conclusion. The energy sector is outperforming the broader markets, and oil volatility historically does increase stock market volatility. And we'll go through a chart to talk about that in more detail too. And just a reminder, the stock market is a leading economic indicator. It's not a temperature check. So the stock market is pricing in what investors and banks think is going to happen over the next 9 to 12 months. So it's forward looking out into the future. It's not a day-to-day temperature check.
Is this me?
That's you.
Okay, here's a chart of oil prices over the last year. So you can see, things are relatively stable, going back last April, kind of bouncing, between 60 and 70. And then as soon as the conflict started, you can see that spike happening. And it kind of spiked up, you know, it's not showing on this chart as being over 100, but it was over 100. So it must have been,
It was intraday
yeah,
trading.
intraday trading and went over 100. So you can see the spike. And right now we're starting to see prices start to relax a bit. Um, One thing that Justin and I were looking at was kind of past oil prices and like back to 2011. 100 was a number that, we could say if it gets above 100, it's a problem. But, going back to 2011, retail sales were about 300 billion. Today there's 600 billion. So oil prices, there's really not, that hundred's not indexed for inflation. So some research we were looking at, 200 is really a problem price point for oil, much more than the 100, even though people talk about the 100. It is a good benchmark to look at, but just keep in mind that that's not indexed for the growing economy,
Yeah.
that 100.
And the stat we are looking at specifically is when, oil was 100 and a problem. You can look at 2008, you can look at 2011. Retail consumer sales were $350 billion a year. And, as of this year, we're looking at 600 to 650 billion. So effective almost a double, right, since that 2008 period. And that's really because of inflation, right? So we've had a lot of inflation. It's caused cost of goods to go up substantially. So cost of goods gone up a lot. Retail sales have gone up a lot because of that. But oil prices have honestly remained relatively stable during that period. They've never really priced in inflation in the same way. That's why we're talking about, 100's always been a scary number for oil, but the real number is north of 100, where we're going to see major concerns, and it's probably well north of 100.
This chart, the blue or the purplish colors, oil prices, and then the orangish color is the S&P 500. So you can see there really is a correlation with oil prices spiking and the market going down. Um, I think you can almost throw out the COVID time period. If you remember, oil prices went negative during COVID for a short period of time. But you can see this spike in oil prices here recently really didn't move the markets all that much. It's, just a small move. And it may be, the fact that markets are looking at this as a temporary spike, not a permanent price increase, due to an economic downturn. Most of the other ones were economic downturn caused the oil prices to go down, not necessarily a supply disruption, but definitely correlated for sure. The question is, what, the chicken or the egg? Does the slowing economy cause the oil prices to go down, or vice versa? But definitely a correlation. So some economic data that is impacting markets right now. The February jobs report was disappointing. We're expecting, roughly 50 to 60,000 new jobs, and came in at a decrease of 92,000. So that's definitely a yellow light, strength of the economy. There was reasons for that. There was a healthcare strike, um, reduce federal government jobs, different things, but definitely a disappointing number. Unemployment rate rose to 4.4. So we kind of view that as cautionary, but not necessarily, a red light or a red flag. Inflation still remains sticky, but really not growing. Tariffs are still there, and then of course energy prices. And along with that, with those numbers flashing yellow, it causes more recession fears. So, you know, we don't see any of these as being a problem or something we need to take action on, or you need to, but it's something to be aware of that, it's definitely not a green light, but, it's something we're watching actively. Okay, the other thing markets are looking at is the Federal Reserve meeting, which starts today, and they announce tomorrow. Um, you know, everybody thinks, that rates will remain the same. So that's priced into the market. Um, it looks like new Fed leadership will be coming in, and that may be, greater chances for interest rates dropping, or Fed rates falling with the new leadership. So still a bias towards rates coming down as we move forward, but not tomorrow's announcement. We see that as coming in as no change, which is priced in.
Good. Last one.
I got one more.
You got one more.
Okay, some key takeaways. The geopolitical events are driving short-term volatility. Um, and I think one key takeaway here is right now is a good time for you to judge what your true risk tolerance is. Um, when we talk to people about risk, um, when things are going up, nobody cares about risk. But when things get a little bit scary, we haven't had a lot of phone calls with people overly concerned about what's going on geopolitically. But some of the calls, what should we be doing? Should we take action? And really, when you look at the volatility you've seen in your accounts, we're still up um, from a return standpoint. But I think people, don't want to lose money, which is natural, but it's also a natural part of long-term investing. Is it's not going to work all the time. So it's a good time to double check, how would you feel if your portfolio was down 5%, 10%? What would you do? And the key there is that you want your risk profile in check with what you can take so you don't make a bad decision. That's what it comes down to. So now's a good time to kind of do a gut check. What do you really feel about risk? Give us a call to talk about it because it's super important. But you know, I look at it that a moderate amount of risk, you should be able to handle a -10 or a -15. Not that we want it, but that would not cause you to abandon your strategy, that type of loss. So,
Yeah, I want to talk a little bit about, staying diversified. We think that is, we've talked to all of you about this. That's what we do. Like that's our core ethos of investing is we diversify our stock investments by sector of the economy, right? So even if you look at what happened in 2025, the markets did really well, up 16, 18%. Energy lagged last year. Energy was up, 8 to 10%. So we would get, some phone calls or some review meetings, people talking about how energy is underperforming. We should be, selling energy. And then last year, financial services outperformed substantially. We should buy more financial services, sell some energy, right? The approach we take is to get good long-term returns, you have to be diversified by sector of the economy. And then, 2026 is a great example where now energy is vastly outperforming the market. Financial services are underperforming. And just to give a couple quick examples on some companies that most of you would know and own, Exxon is up 33% this year. Permian Resources up 40. Phillips 66 up 35. Last year those companies were up an average of 7%. So they underperformed last year, highly overperforming this year. And the counter to that would be financial services. Goldman Sachs was up 60% in 2025. Morgan Stanley was up nearly 50% in 2025. 2026, both of those companies are down nearly 10%, right? Doesn't mean they're bad companies. It means that they had a really good cycle last year in 2025. It's early in 2026. They're giving back some of the returns, but energy is kind of picking up the slack on those, right? So we have to, it's the same reason that when we talk to you about, technology or AI companies that were so good for, 2024, 2025, should we be buying more, right? And our answer was always we own an amount that is appropriate for your risk tolerance. We're not going to chase the returns. At some point the market will flip, and it has, tech companies have pulled back and other sectors of the economy have pushed forward. So I just wanted to point that out real quick.
yep, it's kind of the things you love the most the previous year you might not love in the current situation. So I get it. I have a love-hate relationship with, I love the things that go up and I hate the things that don't. But it's all part of having a diversified portfolio by sector.
Yeah. So I'm just reading a question. Give me one second. So, yeah, so we have a question about private credit, which I think is a very timely and appropriate question, right? So, any thoughts on the private credit markets? The stock market has taken somewhat of an impact from private credit underperforming and companies like Blue Owl and several others limiting redemptions on private credit funds. Is it a credit issue, a liquidity issue, both or neither? And kind of how do we see that impacted moving forward?
I'll pick the first stab at that. So what private credit is, so if you think about bonds, bonds are public credit. And when someone borrows money in a private way, meaning that it's not publicly traded, it's basically a loan that's not traded on the markets. It's a private placement. There's a lot of funds out there. Think of it could be, non-standard lending, could be auto loans, different things that have a little bit more risk to them sometimes. Um, Private credit's a broad category, so you have high quality, medium quality, low quality. But I think so much money has been chasing private credit. These funds are set up, they're bringing in billions of dollars. Some of the people that own private credit probably shouldn't. They have liquidity needs. They're being put in people's models. At other firms, they'll have your pie, and private credit will be part of it. And probably some people that shouldn't own it that need liquidity are owning it, which is causing redemptions.
Hmm.
Um, so we think it's a sector that you got to be careful with. Um, we do own some private credit for all of you, but it's extremely high quality. I don't think in the same category. So I look at it, you could talk about private credit being a thing, just like you could talk about stocks being a category. And there's a big difference between high quality and low quality with stocks. Same thing with private credit. So most of the trouble's coming from the lesser quality and funds that are oversubscribed. And you see that you can't redeem it. Well, private credit's really not a liquid investment to begin with. So it starts out as not less than liquid, and then you put too much money in it, and then you have people that shouldn't own it, is causing the problems and hitting the news. But we don't look at it as the beginning of a financial crisis. It's nothing on that scale, but it's definitely a problem, and it's a problem, especially if you own it, one of those funds,
Yeah.
which you don't.
And,
Nobody does here.
and the fund that you do own has, was vetted for multiple years by Chuck and I and the team before we ever bought any of it. It is more of a boutique private credit fund. It's very high quality. We're close with the leadership team. The performance has been outstanding. They don't have liquidity or redemption issues. I just spent 2 days with them talking about this 2 weeks ago. Right? We're still very confident in that private credit vehicle. And part of what their magic is, they haven't grown fast and on purpose. They've grown methodically so they can continue to buy good investments, take down good deals, and they have sophisticated investors involved. It's not a retail solution, it's more of a solution for firms like ours. So we're very comfortable there, but we're more than happy to talk to anybody that wants to get deeper into private credit.
That's the specifically in your account is the Forum Real Estate Income Fund. That's providing about a 9% yield and has ever since we've owned it. And it's been rock solid. Back in 2022 when the bond market was down 16, that thing was up 9. So it's kind of did not go down when bonds went down, and is a high quality private credit fund.
Good question.
Yep.
Okay, so with that, we'll end the meeting. We'll give you back 6 minutes. So enjoy that. But we appreciate you taking time with us. I know everyone's taking time out of their schedules to listen in. If you have questions that are more specific to you or your situation, reach out to us. We're always here for you. Happy to help. And talk again in April.
Yep. Have a great day.
See ya.
See you.